This is week 6 of Principles of Financial Accounting, our last week. Congratulations on making it this far. I encourage you to stay strong through this last week because it is a good one. Lots of valuable information in week 6. Week 6, our first section is on current liabilities. There are a number of current liabilities, but we're going to concentrate on notes payable. So notes payable is when our company borrows some money and has to pay it back with interest in less than a year. Because it is a current liability, it has to be less than a year. For the most part, you're just borrowing the money, and a number of months later you're paying it back with interest. The key item to remember on notes payable is this: you're going to have the dollar amount, the interest rate, and a period of time. This interest rate is always stated at an annual rate. So that 8% would on $10,000 would be for an entire year. So in this particular case, we're only borrowing the money for a half year. When you pay back the note, you have to remember, multiply by that full year interest, but then take half of it because it was only a half a year. So interest rates are always stated annually. The second topic is contingent liabilities. So the current liabilities that we just talked about are known liabilities. We knew exactly how much our liability was. Contingent liabilities are unknown or estimated. The key to contingent liabilities is this little chart right here. You have got to know the dollar amount and the fact that you will most likely have to pay this liability before you can do a journal entry and put it on your financial statements. A contingent liability is one that is uncertain. I don't know if you remember a number of years ago, the woman who drove through McDonald's and spilled hot coffee into her lap and sued McDonald's, and eventually she won millions of dollars. But at the time she sued McDonald's, McDonald's did not know if they were going to have to pay out on this liability. They would have had to have asked themselves, is it reasonably probable? Can we estimate it? Is it reasonably possible, or is it remote? And whatever they decided would determine how they were going to treat it on the financial statements. If you notice right here, legal disputes are a very common contingent liability. The key to understanding contingent liabilities is this little graphic right here. Our third topic is long-term liabilities. Again, we're going to concentrate on notes payable. The only difference is these notes are more than a year long. That just means we have to calculate interest more often and pay it more often. Whereas the short-term note payable, we just paid once at the end of the note. Next topic is a good one for all of us. It's payroll, paying our employees. Basically, the accounting for payroll is the paycheck. If you've ever looked at your paycheck, you've noticed what comes out of a paycheck. Lots of different taxes and then some other items. The journal entry for payroll looks exactly like the paycheck. The salary expense for your company is how much you pay your employees, and the deductions are all liabilities, because this money that we're withholding from the employees' checks, we turn around and remit to another company, and then the actual cash that we pay is the net pay. So if you understand what a paycheck or pay stub looks like, you'll understand what the journal entry for payroll looks like. And then our last topic is corporations. There's a lot of valuable information in this section that explains the organizational structure and types of stock and dividend transactions. There's a lot of good theory in here and a few basic stock journal entries for the stock and the dividends. As I said earlier, a lot of good information in week 6. So I look forward to discussing it with you, and I also hope you found the entire course valuable and you're leaving the course understanding the financial resources and the financial management of a company with a better understanding. Thank you.